Now we're going to start talking about capital assets, what they are, how we tax them, and how we handle gains and losses from the sale and disposition of capital assets. All right, so capital assets are basically everything unless they're not capital assets. So here's a quick little summary of what is not a capital asset. There's only 4 items you got to worry about not being a capital asset. Items held for sale to customers in the normal course of business. So this is like your inventory. Whatever you're in the business to sell, that is not a capital asset. That is considered inventory. Depreciable property or real property used in a trade or business. And this is key, that it's got to be used in a trade or business. And that makes it not a capital asset. And the reason for that is because your equipment and real property that's used in your business is going to be depreciated. And that depreciation will help offset your ordinary income from your business. And so to treat these as capital assets would really give you the double win. You would be able to deduct your depreciation against your ordinary income and save your ordinary income tax rate. And then when you sell it, if you sell it for a gain, and you treat it like gains, then your gains would be taxed at the capital gains rate, which is a preferential tax rate. It's much lower than your ordinary rate. And in fact, in most cases, it's half. So here you'd be able to take the deductions against the higher ordinary income and report the gains at the lower capital gains rate. So that's why you're not allowed to take depreciable property or real property that's used in your trade or business as a capital asset. Creative works, music, etc., that are created by you, that is not a capital asset. Again, that's kind of more like inventory, if you will. You're probably in the business of, making music or writing or whatnot. So that has to be treated as ordinary income. Accounts receivable, again, a lot of people will buy and sell accounts receivable. So these items are not a capital asset. Certain government publications, no clue. Got no idea what those are. Never seen those before, but I guess people are buying them and selling them, but those are not capital assets either. So all assets are capital assets unless they meet one of the above exceptions. So, I mean, really, these 2 or 3 here, these are all related to your business. So if it's something used in your trade or business, it's not going to be a capital asset. So just a quick thing to remember, same thing here. This is accounts receivable. That's in your trade or business. You get an accounts receivable from being in business. And so these 3 items, really this one here, because if you're creating music or books or whatever for sale, that's kind of your business. So all of these items are really related to business. So capital assets are basically everything that's not part of your business. And so this starts to matter because when you sell capital assets, the tax is a little different on it. And the first thing we got to consider, is the capital asset a long-term or short-term asset? And that's a super easy thing to determine. A long-term capital asset is if you held it for more than 1 year, and a short-term is anything under 1 year. And then to calculate the holding period, the IRS gets weird with it. You exclude the date of acquisition, but include the date of disposition. I don't know why they do it. Really, you very, very rarely encounter somebody who's selling it at exactly 1 year. Usually somebody's selling it and it's like 14 months or 17 years or something along those lines. And so it's a no-brainer. So we don't really worry about this. But in case you get down to the absolute razor edge, this is how you calculate the holding period. Exclude the date you bought it, but include the date of disposition. The holding period determines how the taxes are going to be calculated on it. Long-term rates are much better than your ordinary income tax rates. In fact, they're often half. And sometimes for some people, they can even be 0. So it's possible to sell a capital asset, make money on it, and pay 0 tax on it. And so that's why this is so important. And I cannot tell you how many people have come to me and told me they sold something after 11 months and have this big old gain, and now they have to pay ordinary income tax, which is often double than what the long-term rate is. So you always want to be cognizant of where your holding period is on any asset you're about to sell. That's, of course, not in your business. So maybe you have a boat or something like that, and you're thinking of selling it, and you're going to make a lot of money on it. Really, this comes into play a lot with stocks, and we'll look at an example of that here in a minute on stocks and bonds and investments. That's where a long-term and short-term really comes into play. And then the short-term just uses your ordinary income tax rate. And so that can be anything from 0% for low-income taxpayers to 35% or more for higher income taxpayers. So most people nowadays, if you're making a decent salary, you're married, filing jointly, you're probably going to be around the 12 to 22% tax bracket. And then if you're really doing really well, around the $300,000 or $400,000 range, you're going to be in the 25 to 35% bracket. So is it a gain or a loss? So, real simple, the old saying goes buy low, sell high. That's kind of what we got here, but we got to take some calculations into account here. So the amount realized minus your adjusted basis equals your gain or loss. And so let's look at these a little more in detail. Amount realized, 90% of the time, it's going to be just cash that you received. Somebody buys something from you. You sell your stock on the stock market and get cash for it. It's just that simple. So most of the time, it's just going to be the cash you received. But sometimes you might do something fancy and get creative with it where now you're giving up other property. I want this 10 acres over here. You want this 5 acres that I've got here. So you might trade me. I'll take your property, you take my property, but they're not equally valued. So you'll give me some more money for it. And then maybe we got loans and we're going to say, okay, well, I owe money on my property, but you'll take over that mortgage. And so you've got to add all of that. So you treat any liabilities that are transferred from you to the new owner as receiving value. Because if you owed $10,000 on your property and that guy agrees to take over your loan, now you're better off by $10,000, right? Because you don't have to pay that loan back, he does. So you treat that almost like cash. They took something away from you and you're better off now. And so that is added to amounts you realize. So cash, the value of any property you receive plus the amount of any liabilities you transfer out is the amount realized, but you do get to subtract closing costs. This is very common in real estate transactions. There's usually quite a bit of closing costs, and so that comes out. So you might agree to sell your property for $100,000, but closing costs are $5,000. So you subtract that, and the amount you realize would then be $95,000. So this is how you come up with your amount realized. Pretty straightforward. Like I said, most of the time it's just going to be your cash received. And from that, we're going to subtract your adjusted basis. An adjusted basis is a little easy to calculate. It's generally just your original purchase price. With the stocks and investments, that's sometimes all you have is just your original purchase price. But for other items, you might have some improvements. So, maybe you put a new roof on a property or something, or, put up fencing or built a pond, something along those lines, some sort of improvement. This wouldn't really be small repairs. Fixing a broken window isn't really an improvement. That's just a repair. But replacing every window in the house, that would be an improvement. And then if you did any depreciation on the property or equipment, you would subtract that. So let's say you bought a house for $50,000. You put a new roof on it for $20,000. So now your adjusted basis is $50,000 plus the roof is $20,000. So you have a basis of $70,000, but then you used it as rental property or something along those lines and you depreciated it for $10,000. So you'd subtract that out. And now your adjusted basis would be $60,000. The $50,000 you paid for it, the $20,000 of improvements equals 70 minus the depreciation of 10 would give us a $60,000 adjusted basis. And that would equal your gain or loss. If you have a positive number, it's a gain. If you have a negative number, and in taxes, we often use these parentheses to indicate it's a negative number or a loss. And so that's all you would do. Amount realized minus your adjusted basis equals your gain or loss. So that's a quick recap on what capital assets are. And now we're going to start looking at how we tax any gains or losses we have on our capital assets.